We know the stock market has been on a tear, but the stock and bond markets are both flashing signals we haven't seen since the dot-com bubble. And the last time these lined up at these levels, investors lost a decade. One of these signals doesn't just suggest caution, it has historically projected what the next 1, 2, and 3 years could look like, and by how much. In this video, I'll show you exactly what those signals are, what they mean, and what to do next. Stocks and bonds are constantly sending signals about growth, inflation, and risk. Sometimes they confirm each other, sometimes they contradict. Both signal sets are valuable. Let's start with the bond market. The signal we are focused on is the credit spread. That's simply the extra interest a company must pay to borrow money compared to the US government. It's the premium investors' demand for taking corporate default risk. When spreads are wide, investors are nervous. When spreads are tight, investors are confident. Right now, they're extremely confident, maybe too much so. Earlier this year, investment-grade corporate bonds were paying just 0.71% more than comparable US Treasuries, less than 1%. That's the entire premium investors demanded for taking on corporate risk. The last time spreads were this tight? 1998, the peak of the dot-com bubble. And this signal is telling us we're in a high-risk, low-reward investing environment. When spreads are this narrow, there's almost no room for them to tighten further, but there's plenty of room for them to widen. High risk, low reward. And here's what most people miss. A single bad headline can unwind it fast. Tariffs slow the economy, a major company misses earnings, a bank reports unexpected losses. Suddenly, the risk premium that should have been there all along comes rushing back in, and yields spike. Then two things happen. Existing bondholders lose money because new bonds pay higher interest. I go into more detail on that mechanism at the end of this video. And more importantly, corporations suddenly must borrow at higher rates. The cheap financing environment disappears. Economic activity often declines. Layoffs follow, earnings shrink, and the stock market, which had been riding on cheap debt and optimistic earnings projections, starts doing the math. The bond market doesn't panic, it warns. And right now, it's warning that risk-reward is badly skewed. And in its own way, the stock market is telling us the same thing. The signal that is flashing is the CAPE, or the cyclically adjusted price-to-earnings ratio. And this one doesn't just tell you the market is expensive, it tells you specifically what has happened next. Every time we've been here before. The CAPE ratio was developed by Nobel Prize winner Robert Shiller. Instead of comparing today's stock prices to this year's earnings, it compares prices to the average of the last 10 years of inflation-adjusted earnings. It smooths out the boom and bust cycles in profits to give you a cleaner read on whether stocks are actually cheap or expensive relative to the underlying businesses. Earlier this year, the CAPE ratio hit 40.2, the highest reading since September 2000, the dot-com peak. The month before the crash that wiped out half the S&P 500 and took 15 years for some investors to recover. To put that number in perspective, a CAPE ratio above 40 has occurred less than 3% of the time going back to the 1950s. And here's where it goes from uncomfortable to alarming. Researchers went back and looked at every single instance where the CAPE was above 40. Then they tracked what the S&P 500 did next. Historically, a CAPE ratio this high correlated with modest losses in the next 12 months and steeper losses in the following 2 years. As the chart indicates, 1 year out, the average return was negative 3%, 2 years out, negative 19%, and 3 years out, negative 30%. And even under the most optimistic historical scenario, the 3-year return was still negative 10%. There is not an instance in this dataset where the market was positive over 3 years after a CAPE ratio reading above 40. In a high-risk, low-reward market, stock selection matters more, and seeking alpha has outperformed the S&P by over 65% since 2022. There's a link for 10% off in the description. Now back to the CAPE ratio. A CAPE ratio over 40 doesn't mean the market drops tomorrow. In fact, some of those periods had short-term rallies before the decline hit, but what it means is that buying stocks today and expecting the next few years to look like the last few years is betting against 70 years of market history. The counter-argument you'll hear, and it's worth acknowledging, is that AI could change the earnings trajectory fast enough to bring the CAPE ratio back down even if prices don't fall. If profits surge dramatically, the valuation corrects itself without a crash. That's possible. But it's also exactly what investors said about the internet in 1999. New technology, new rules, new era. Until it wasn't. Right now, these two signals are in sync, maybe too much so. Complacency is elevated, optimism is high, low margin for error. So, you need a plan. Some investors choose to de-risk at these levels and rotate out of higher beta assets. And watch the credit spreads. If credit spreads start widening while stocks are still near highs, that's often when things start breaking. Credit cracks have preceded multiple equity downturns. Widening credit spreads signal higher corporate borrowing costs that can lead to decreased economic activity, layoffs, lower earnings, and ultimately lower stock prices. Stocks reflect earnings optimism. Bonds reflect risk tolerance and economic probability. Historically, when major divergences appear, the bond market tends to be right more often than equities. When bonds start pricing stress while stocks stay euphoric, you're often late cycle. These signals aren't perfect, but what they are signaling now is high risk, low reward. Credit spreads have little room to do anything except widen, and it wouldn't take much to make that happen. As confident and complacent as most investors are, an earnings miss, AI's productivity payoff not materializing fast enough, or a bankruptcy would likely be enough for bond buyers to start demanding higher risk premiums. That could be the canary in the coal mine that allows the S&P's historical returns after a CAPE ratio over 40 to materialize. The margin for error is thin, and when the margin for error is thin, small cracks matter. And none of this is personal financial advice. This is education so you can build your own plan. If this shifted how you see the current setup, hit subscribe. We publish fresh content multiple times per week, helping you protect and grow your wealth, and keep the momentum going. Watch why the stock market hasn't crashed yet, what they don't want you to know. It's on the screen. In the description, you'll find links for 10% off Alpha Picks. You'll also see a link to my Wealth Builders Blueprint, a large collection of resources you can use to grow your wealth. I also included a link to Zacks Confidential, a more economical alternative to Alpha Picks. Check them out. If you want a deeper dive on the relationship between yield and bond prices, give me another 2 minutes. Otherwise, thanks for watching. See you on the next one. Bond prices have an inverse relation to interest rates. When interest rates rise, bond prices fall, and vice versa. Seems counterintuitive, but it's not. It's because you can either buy a new bond from an issuer or an existing bond in the bond market. When interest rates rise, newly issued bonds pay higher annual interest payments than bonds issued when rates were lower. When interest rates fall, the opposite happens. Generally speaking, investors always want the bond with the higher interest rate, so the price of existing bonds adjust. If existing bonds pay higher interest rates, they can sell for more. If they pay less, they have to reduce their price. That's the Reader's Digest version of why rates and bond prices move in different directions. If you want more, keep watching for another 90 seconds. You need to know 3 key bond terms: par or face value, price, and current yield. We're ignoring yield to maturity for now. Par or face value is what the bond returns at maturity. A $1,000 par value bond pays $1,000 at maturity. Price is what you pay for the bond. Don't confuse price and par value. A bond's price doesn't always equal its par value. Current yield is the return you receive in the form of interest. Current yield is calculated by dividing a bond's annual interest payment by its current price. Something else to note. The annual interest a bond pays, also called its coupon rate, is fixed at issuance. Unlike yield, it doesn't change. If a $1,000 par value bond pays 5%, its annual interest payment will always be $50. If that bond's price is also $1,000, its yield is also 5%. Pretty straightforward. But things change when interest rates rise or fall. Let's assume I own the bond we just discussed, $1,000 par value with a $50 annual interest payment. My bond is currently priced at $1,000. If interest rates rise to 5.25%, new bonds become more valuable. A newly issued $1,000 par value bond will pay an annual interest payment of $52.50, and have a yield of 5.25%. You wouldn't pay me $1,000 for my bond when you can buy a new bond for that same $1,000 that pays higher annual interest payments. So I have to lower the price of my bond until its yield equals the yield of the new bond, or 5.25%. That price happens to be $952. Conversely, if interest rates fall to 4.75%, I can raise the price of my bond since new bonds pay lower annual interest payments. There are other factors that affect a bond's price, such as time left to maturity, but I ignored those for simplicity's sake. So in a nutshell, that's why interest rates and bond prices move in different directions and why a particular bond is priced the way it is. I hope you found this useful. Thanks for watching.